China just opened its war chest and dumped endless billions into their market alongside other forms of unprecedented stimulus. And as a result, China's stock market has already just seen its biggest single-week jump since 2008. And you look at some specific popular Chinese stocks, NIO is up 25% in the last 5 days. XPeng up 34%, Alibaba up 20%, JD.com up 37%. You pull up the Shanghai Stock Index, it just saw an extremely sharp and unprecedented turnaround. Hong Kong stocks, which have underperformed for years, are now almost level with the S&P 500 all of a sudden. And so folks, there's a lot going on, and in today's video we need to go through 3 things. Number 1, what these stimulus measures are that China just enacted. Number 2, why China needed these stimulus measures so bad in the first place. And 3, and also most importantly, how to make money off this. We'll break down the stocks that are likely to be impacted by these measures the most, including key American ones that do substantial business in China. And as always, if you're the one taking the risk, make sure that you're the one that is doing the ultimate frisk. Do your own due diligence on all ideas presented here on the channel. Also, quick plug, don't miss out on our free daily email newsletter reports. We cover the hottest trending stocks before they go trending, newest catalysts to watch out for, and much, much more. We've identified some pretty big runners recently, and you don't want to miss out on our common reports for this week. These free emails are game-changing, and I guarantee it's worth the 5 seconds to sign up for free. I'll put that first link down below. Okay, firstly, we need to talk about the stimulus. Now, China isn't just throwing a little cash around. No. Papa Xi is going all in on this one with a massive package that's going to shake things up across their entire economy, and quite frankly, the entire global economy as well, and our market here at home. We're talking about some serious moves in monetary policy, fiscal spending, real estate support, and some downright desperate proportions of investment. From the Financial Times, quote, the People's Bank of China on Tuesday unveiled a 114 billion USD war chest to boost the stock market by lending to asset managers, insurers, and brokers to buy equities, and to listed companies to buy back their stock. This was the first time the PBOC, the People's Bank of China, had innovated and used these types of monetary policy tools to support capital markets, Central Bank Governor Pan Gongsheng said at a briefing flanked by financial regulators. Folks, this package is a direct infusion into the stock market, which will likely multiply in the coming weeks in terms of effects. Now, what about the measures they've already been taking all year that they are now doubling down on as well? They've been cutting their key interest rates, the 1-year and the 5-year loan prime rates, which basically makes it cheaper for businesses and people to borrow money. They do it a little bit differently over there. They have a 1-year and a 5-year, but still it's the same general idea. The banks are also changing their reserve requirement ratios. This is the amount of cash banks have to keep on hand. By lowering that, banks can lend out far more money. China's also doing targeted loans for struggling businesses. The PBOC has a plan to help what they say are the little guys, small and medium-sized businesses that are hurting. Of course, if you're not a loyalist to the CCP, I don't know if you're going to get one of those loans, but nonetheless, I mean, most people are loyalists just because if you're not, well, let's just say you might get re-educated and then you'll be a loyalist. But anywho, back on topic here, China isn't just leaning on its central bank. They're also rolling out fiscal stimulus, which is government spending that directly impacts different sectors. China's spending tons of money all of a sudden on roads, bridges, high-speed trains, and yes, even new cities. China is infamous for spending billions into cities that then all of a sudden become ghost towns, but nonetheless, they do create a lot of jobs. China is pumping billions into infrastructure, and these projects are expected to cause a nice resurgence in China's economy. On top of that, China is also actually offering tax cuts to businesses to keep them afloat and encourage new investments. And for consumers, they're giving out rebates on everything from electric cars to home appliances. They're also providing subsidies for struggling industries. Certain sectors like real estate and manufacturing are getting a lot of extra love. The government is throwing subsidies hand over fist at these industries to stabilize them. But anyways, that leads us over to real estate. There's a lot being done in real estate right now because that's really the biggest crisis in China. It's no secret that China's real estate market is in a long-term tailspin. Evergrande, Country Garden, and other big developers have been defaulting, leaving millions of homes unfinished, and other homes not even housing anybody. That's a huge problem because real estate has been the backbone of the Chinese economy. You might not have known this, but China has a very, very high home ownership rate, with over 90% of households owning their homes. This is much, much higher than in many Western countries. And so when the real estate market is under threat, well, that's a lot of people's wealth just all of a sudden exploding. And that can destabilize a lot of the economy. So what's the government doing about that? Well, number one, they're easing mortgage rules, making it way easier for people to buy homes. That means lower down payments and fewer restrictions on second home purchases. The idea here is to get people buying again and stabilize these housing prices. They're also doing rescue loans for developers. Property developers are getting government-backed loans to finish these ghost town projects you've probably seen on the news and that we've been talking about. This will help restore confidence in the real estate market, keep construction jobs going, and prevent the economy from collapsing under a real estate meltdown. It's a lifeline for the sector, and if it works, we could see a real recovery in China's housing market, which would have a huge ripple effect on their overall economy. Anyways, China is spending big right now, and their stimulus is hitting every part of their economy, from cheaper borrowing to massive government spending on infrastructure, saving the real estate market, boosting consumer spending. Well, they're pulling out every tool in their toolbox to keep their economy moving forward, and this is going to create some major opportunities for market participants. Now, before we even get into where those opportunities are, I do want to cover why China needed this stimulus in the first place. Well, for starters, global demand for Chinese goods has long been in the toilet. China's exports, one of the traditional pillars of its economy, have been falling off a cliff. There's weak global demand, the global economy has been slowing down, and with high inflation and tightening monetary policies around the world, there's been less demand for Chinese products. Think about it, if the rest of the world is buying fewer goods, that's going to hit China's manufacturing sector super hard, right? On top of that, US-China tensions and sanctions on tech have been making things worse for their economy. We're talking about tariffs, supply chain issues, and restrictions on key technologies like semiconductors. These trade tensions have put pressure on China's export sector, especially in high-tech industries, which are critical to China's long-term growth plans. To combat this, China's government is providing subsidies to manufacturers to keep production going, especially in industries where they need to stay competitive globally. They're also focusing on domestic consumption to make up for the drop in foreign demand. In other words, if the world isn't buying as much, China's trying to get its own people to pick up the slack. Here's a crazy statistic for you. Youth unemployment in China recently hit a record 20%. That means 1 out of every 5 young people in China can't find a job, and that's a huge problem for the future of their economy. Youth unemployment is a double-edged sword. On one hand, it means there's less disposable income being generated by young people, which feeds into the overall slowdown in consumer spending. But on the other hand, it's a political problem. A large number of frustrated, unemployed young people could create instability down the line. That's why a lot of the stimulus measures are aimed at creating jobs, especially through infrastructure projects. Infrastructure spending is one of the fastest ways to put people to work, and China's government is betting big on it. Finally, we can't ignore the big picture. China's GDP growth has been slowing, and that's a huge deal for a country that's been known for decades of rapid expansion. The government sets an annual GDP growth target, sort of like a performance goal, and lately they've been missing the mark. So that means that China's leadership is under serious pressure to get the economy growing again, and that's why they're injecting so much money right now. Slow growth isn't just an economic issue, it's a political one. When growth stalls, it undermines the narrative of success that the government has been promoting for years. This stimulus is a way of signaling to the world, and more importantly to their people, hey, we're still in control and we're going to get this ship back on course. You combine that with the big issues with the Evergrande and the Country Garden and the rest of the many millions of homes that have been developed halfway and are sitting unfinished, well, lots and lots of buyers and Chinese citizens are being left in limbo, paying for homes they can't move into, and prices are going down, and the overall biggest, most important sector of the economy, real estate, is collapsing. Real estate is about 30% of the entire economy, so if China just sits on their feet and doesn't try to fix and stimulate away their real estate problems, well, there's going to be real hell reckoning. Okay, so with all this stimulus trying to reinvigorate the Chinese economy and the Chinese markets, well, where are the opportunities? Let's start with the obvious: Chinese stocks. The stimulus package directly targets several sectors that are critical to China's economy. China has been pushing hard on its green energy goals, and electric vehicles are at the heart of that plan. The government is offering huge subsidies for EV buyers, making it cheaper for consumers to purchase new electric cars. And with EV infrastructure like charging stations getting a massive upgrade, the sector is going to see a lot of love in the coming months. So, some of the stocks that you should know are: number 1, NIO. NIO is already on fire, up 25% over the past few days, and this could just be the beginning. NIO is one of the leaders in China's premium electric vehicle market, and with the government throwing even more support behind green tech, NIO could see its sales skyrocket. On top of that, NIO's battery swapping technology gives it a unique edge over competitors. There's also XPeng, ticker symbol XPEV. XPeng is another major player in Chinese EV market, and they've got a solid pipeline of smart EVs, including self-driving capabilities. With XPeng up 34% recently, China's push for high-tech autonomous vehicles could make XPeng a long-term winner. The government's focus on smart cities and automated infrastructure means XPeng is positioned to ride the stimulus wave for the foreseeable future. Don't sleep on BYD. They're not just making cars, they're also one of the biggest largest battery manufacturers in the world. Tesla has a customer and a major footprint in China's EV market. BYD stands to benefit from both the consumer and infrastructure sides of the stimulus package. Next up, you got to look at the e-commerce players. China's consumer sector has been sluggish, but with the stimulus package directly targeting consumer spending through subsidies, rebates, and tax breaks, well, this is about to change. That means big players in the e-commerce space are going to see a surge in activity as people start spending again. Alibaba is the heavyweight in China's e-commerce landscape. It's not just an online shopping platform, it's an ecosystem that includes cloud computing, logistics, and financial services. With China's consumer market about to get a jolt from government incentives, Alibaba is positioned to be a major beneficiary of the stimulus. As spending increases, especially in rural areas where Alibaba's logistics network is the strongest, expect the stock to keep climbing. JD.com is another e-commerce giant that has already been on a big spike, up 37% in just a few days, but what sets JD apart is its focus on logistics. It owns its own distribution network, which means faster and more reliable delivery. As China's stimulus starts to flow through the economy, JD.com will likely see a major boost in online retail, especially with its strong foothold in electronics and home appliances, sectors directly targeted by consumer rebates. One of the big goals of China's stimulus is also to ramp up its technology game, particularly in semiconductors, AI, 5G, and automation. And if you're looking for those stocks, you got to look at Baidu, often called the Google of China. Baidu isn't just a search engine anymore. They're heavily invested in AI research and autonomous driving, both of which are critical areas of China's stimulus plan. As the government pours more money into innovation and automation, while Baidu could become a leader in AI applications and smart infrastructure projects. There's also Tencent. Tencent is not only a dominant force in social media and gaming, but it's also pushing hard in fintech and cloud computing, with more emphasis on China's digital economy. And as more people engage in online shopping, streaming, and digital payments, Tencent stands to gain in multiple verticals. Okay, but what about the American stocks? While Chinese stocks will undoubtedly feel some of the most direct impacts of the stimulus, well, there are several American companies that do substantial business in China. These companies could be close, but indirect beneficiaries of the stimulus, making them attractive plays for investors who don't want to dive headfirst into Chinese markets, but still want that exposure to the stimulus. So, number one is definitely Apple. Apple is a huge player in China, both in terms of sales and production. China is one of Apple's biggest markets, and the company relies on Chinese consumers for a significant portion of its revenue. As China pushes consumer subsidies for electronics and boosts consumer spending, Apple sales in China, especially for iPhones, Macs, and other high-end devices, are likely to surge. On the production side, if China's stimulus efforts revive the manufacturing sector, this could also help smooth out supply chain issues, benefiting Apple in the long term. Investors looking for a solid U.S. stock that's poised to benefit from China's economic recovery should keep a close eye on Apple. Tesla is another major American company with deep ties to China. Not only does China account for a significant portion of Tesla's sales, but China also operates a massive gigafactory in Shanghai. With China's continued focus on green technology and electric vehicles, Tesla is likely to see a boost in sales as Chinese consumers snap up EVs with the help of government subsidies. Tesla could also benefit from China's investments in EV infrastructure, particularly in terms of expanding charging networks and building out smart city infrastructure. So if you're bullish on the EV sector, Tesla's exposure to the Chinese market makes it a top pick. Number 3, Qualcomm. Qualcomm is one of the world's largest suppliers of semiconductors and mobile technology, and a lot of their business comes from China. As China pushes forward with its tech ambitions, especially in 5G and AI, well, Qualcomm is poised to benefit from increased demand for its chips and mobile solutions. The more China invests in its digital infrastructure and smart cities, the more Qualcomm's technology will be in demand, both by Chinese manufacturers and for export. If you're looking for a U.S. tech play with major exposure to China, Qualcomm is a solid option. There's also Nike. Nike is another U.S. company that has a massive presence in China's retail market as China's government encourages consumer spending, particularly on consumer goods like clothing and footwear. Well, Nike is likely to see a boost as well. China is Nike's second largest market after North America, and with consumer confidence slowly returning, Nike could ride the wave of increased retail activity. If China's economy rebounds, expect Nike to capitalize on the country's growing demand for lifestyle and athletic wear. Anyways, to sum it all up, China's stimulus is creating opportunities across multiple sectors and multiple countries, and both Chinese and American companies stand to benefit. Whether you're a short-term trader looking to capitalize on momentum or a long-term investor betting on China's recovery, well, there are still plenty of ways to profit from this massive economic shift. Anyways, that wraps up today's video. Make sure to hit that ravishing like button and subscribe and join our absolutely free email list, and we'll see you in the next video.